Yeah.
So so let's jump into this John Burns piece. Looking at total new apartment supply. This is you had some interesting notes in the show notes of so really hoping that this would be more of a prescriptive, kind of a how-to guide, and there's some bits and pieces, but it takes a little bit. Maybe we have to buy some consulting from John Burns.
It's a good headline. It got a lot of clicks. You click on the newsletter headline, and it's not a measure of the quality of sometimes of the article. But this article did have a lot of quality. It just did not explicitly answer how to ride the apartment supply wave. It gets us close enough where we can connect the dots ourselves. But, from an English teacher's perspective, I would say, what your thesis statement is. I don't know it. So you have to be a little bit more explicit. Okay.
Okay.
It's going to sound a little repetitive. It's going to sound
the doctor is in.
Yeah.
Professor.
Well, it's something I've said a lot before, and it's good to know that tendency is present at all levels.
Yeah. So what? But there's still a lot of it in this article. What are some of your main takeaways? And do we want to go to one of the first graphs? Or want to talk about some of these specific markets?
Might as well. Yeah, we can start at this first graph. The article starts out with an overview of the size of the new apartment wave that is expected. New apartment supply. I'm sorry. And there's an interesting graphic right here that you can see that ranks these major markets according to how many new apartment units were added last year and how many units are currently under construction.
Wow. Look at Dallas, which obviously, again, we've talked about this a lot, Matt. Dallas is a great growing market, a lot of new jobs, a lot of people moving there.
Mm-hmm.
But, they've added 20,000 units in 23 and planning on delivering, or there's 55,000 additional units that are under construction that'll deliver through 24, and probably through 25 as well. That's a lot of units.
For sure.
Dallas is a big MSA, but and it's not growing like New York, but they're delivering quite a few more units than New York.
And I actually I kind of can see the usefulness here of including the units under construction as well as last 12 months. And I could be persuaded you could even include 2022 deliveries
just
as
what
what
the whole impact over like the recent time period has been.
Because some of these, I'll just use Phoenix as an example of, and I'll have this later in the notes, so I'll repeat myself, I'm sure, of these markets that they seem to catch fire really quick during the pandemic. And it seems like multifamily builders moved in there. They didn't stop. They have not yet stopped building, and they won't stop building. And
True.
For markets, for the kind of relatively smaller markets, so I'm comparing Phoenix and Austin to Dallas and New York. Though, the relatively smaller cities, they don't have the population that is as easy to absorb as a giant like megalopolis would. And that's one of the shortcomings of this chart is it's a raw numbers chart. You don't see
it's not relative.
A percentage, but they do have a percentage chart if you go down. So the implication is with both of these charts here, how to ride this apartment wave. So the apartment wave supply, well, maybe avoid, if you're an investor, avoid the markets that are going to get a lot of supply. And specifically in this chart, it measures inventory growth as a percentage, which is what I was looking for. And then as a proxy for demand, it uses rent growth. I usually think of apartment demand as like absorption or occupancy, but that's fine. This is a new way of doing it, and that's fine. It's just not my typical rule of thumb. But yeah, pick the right markets. They don't explicitly say it, but they do. Well,
it's kind of what this is all about.
Yeah, exactly. So again, it's like I can get it, but just say it. Can you just say it for me? Just say pick these markets.
So on this graph, on the I guess the axis over here on the left, the vertical axis is apartment inventory growth, last 12 months deliveries divided by existing units, and then on the bottom we've got the rent growth, the year-over-year rent growth.
Mm-hmm.
And so again, there's a big cluster here, kind of over on the far right, with the U.S. national average being rent growth they have it like right around 1 instead of flat essentially. And the inventory growth kind of right around kind of 2.5, and a kind of a decent cluster.
Mm-hmm.
But some of the outliers in terms of both kind of on the top left are markets you want to be worried about if they're building a lot of units, but also are seeing negative rent growth. The biggest one I would be Austin on this list, where they've got around 6% new inventory growth relative to existing supply, and they also have negative, 5.5% rent growth. Salt Lake City also really high on new supply, above 7%. Nashville at 7%, and both of them also in negative territory, but closer to like -2. Jacksonville also negative rent growth, strong supply 5.5. Orlando closer to 4.5 with negative 4.5 new supply with negative 4% rent growth. Phoenix, Atlanta, Portland with a little less supply coming online. All concerning. And then the markets that are delivering the least, and as a relative to inventory, like New York, which is delivering a lot of units, but again, New York's really big, so that makes sense. But so let's find Dallas. Because Dallas, again, that seemed like a lot of units, and it is on the top left of the main cluster of markets, with seeing basically 3% new supply relative to existing inventory, and basically negative, little more than -1% rent growth. So it's not like good news for Dallas, but I guess it's not as extreme, the new supply compared to Austin, which isn't shocking, really. Raleigh-Durham also, which has really been a poster child for like kind of a perfect market over the last 5 years or so, with the research kind of triangle, good demographics, but just again, everyone saw the Carolinas as a great looking market, and everyone can have the same good idea, and it can turn the good idea into an average or even below average idea. Because again, if everyone makes the same bet, the return goes down. You drive the price up, and the opportunity isn't there unless you're only looking at one metric, and that is migration and population growth. And now what we were talking about earlier today, when discussing a deal that we're looking at right now at Great Capital, is that it's what's the net? It's like, what's the migration, the population growth, the job growth, net of the demand in supply. What is, it's not just supply, it's not just demand. Like, what's the net of supply and demand? How many more units do you need relative to those that are in the market? So you'd be like, well, we need, there's 4,000, there's going to be 4,000 units absorbed. That's a ton of people. There's going to be 4,000 people moving to this market. That's going to be great. That's a positive sign. But logic would tell us that if you're building 8,000 units, new units, just because you have 4,000 people that are coming, households that are going to rent those units, you're still going to have negative rent growth, and vacancy is going to go up. So it's the net. And that's exactly what's happening in these markets. You've got tens of thousands of people that are going to be moving to some of these markets, but you're building 20,000 new units. So we built twice the amount of units in these, and most of these are the deliveries are being concentrated in some submarkets. It's not like they're evenly spread out across the nation or even in a city. It's like they're all in the same suburb or the same little neighborhood.
It is interesting looking at, where things were built before and after. There really is a wave. And elsewhere later in this John Burns report, you see the permitting activity is a whole lot different than the amount of apartments that were built. So like in some places, they built a lot, and they're going to complete a lot in 2024, but moving forward in the next few years, they're not going to complete a lot. The activity is going to really fall off a cliff. And they have a ranking here, and San Francisco has had their multifamily permits fall off the most, followed by Seattle and New York.
And I bet that's compounding off of probably some previous years of permits declining in San Francisco.
Yeah. But there are others that are increasing, which is
that was interesting to see. That was interesting for me to see. Miami, which has got a lot of new supply coming online. It's a whole other dynamic down there in South Florida, though. So, and same, San Diego, I think, is the same way. They it just has different dynamics, especially compared to San Francisco. It's completely different. And separate from LA, also San Jose and Charlotte. Those are the 4 markets that are seeing permits go up. Charlotte, it would be a market that would concern me a little bit.
I agree,
because it's having some trouble right now. Let's go back to this inventory growth. Let's find Charlotte real quick.
Look at the top. Look at the top for proportion of supply. I don't know if it's on this little scatter plot
here. How could Charlotte not be on there?
I agree rhetorically. Other than maybe something's
maybe it's overlapping.
Yeah, I don't.
Oh.
Well, we can scroll up and look at the total. We can look.
Oh, yeah.
We can look up and see. How
here we go. Well, now again, this isn't relative to inventories, but you know they delivered just under 14,000 units last year.
Assume that it's a lot. We have information that would corroborate that from the Fannie Mae report too.
Okay. Yeah. Okay. Well, let's look at the Fannie Mae report here in a minute, but they've got 33,000 units that are under construction. And Charlotte's a decent sized market, but that's a lot of units.
Yeah. Yeah.
That's a lot of.
And I like how, with these three kind of charts, they look at, where things have been and where things are right now, maybe in terms of rent growth and apartment supply. And then when you look at the permits, is, what are they going to be in the future? So if you want to ride this wave, you want to figure out where you're going to get on the wave and where you're going to land.
Yeah.
And some of these markets, I'll call out Miami specifically.
Calling you out, Miami.
I think Phoenix to a certain extent and Charlotte to a certain extent, their permanent activity and their previous building activity, they are still building units. And it has the construction activity has abated somewhat, but not a whole lot. Cities with the biggest positive change, again, Miami, San Diego, 36% increase in permits, San Jose at 22%, Charlotte, 22% change, 22% increase in permits. That's crazy.
Yeah.
And then Salt Lake City was flat with the same permit, but the rest are negative.
Yeah. They had a lot last year too.
Crazy. What's interesting too is if you look at the chart right here that we have where this scatter plot of
the one Fannie Mae.
Oh yeah, we can look at the Fannie Mae one. That's fine. It was similar information. If you look at the places that are adding the kind of least amount of new apartment supply, but as a percentage of current units, it's a lot of Midwestern markets. Those are the ones that seem to have the strongest rent growth as well. And so you can see that there's that correlation there. And those Midwestern markets are not the ones, we'll go over migration reports, but those are not the ones that are benefiting from migration. What they're benefiting from, at least from a multifamily investor's perspective, is a lack of supply. The inverse to all of this discussion about strong markets and all of these too. So like the economist's favorite markets, the renters, it's going to be renters' favorite or least favorite. So it's a benefit.
Yeah.
If you're living in Charlotte, great. Maybe your rents are going to come down. So these are, this is definitely from the perspective of an investor, and it's useful a little bit for a reminder.
So the difference between, I think, Matt, this chart and the last chart is this is taking a look at all of the units that are underway.
Yeah.
Which instead of in the last chart, they broke out units that were delivered last year and then just 2024 expected completions versus all units underway could be 2024, 25, and even 26 scheduled deliveries. That's what I'm all kind of, because they're just calling it, underway projects, multifamily units underway, because there's a big difference in the units underway percentage of market units, which is, goes up to, the mid-teens versus on the John Burns chart. It's
actually completed. Yeah.
Yeah. They were completed, and it's completed over the last 12 months. And I mean, the top, Salt Lake City tops out at 7%. Versus, again, kind of Salt Lake City. Let's find Salt Lake City real quick. That's closer to, 9%. And, we've got Charlotte here at, 14.5. That answers that question here, at least according to this chart. And then, Dallas, I've got New York and Dallas flipped because I think over the time period it's more. But you can see the difference between deliveries and percentage of inventory, basically 4% versus, 6.5. But again, for Dallas, it's a lot of units, but that's much more healthy than, again, Austin's that is basically, up at 14. Atlanta is basically on par with Dallas, right around 6%. But Matt, to, your point, if you go down to some of these, Midwestern markets, like a Kansas City, that's right around a little above 4, or even Indianapolis, which is delivering more than some other markets for probably decent reason, but there's definitely going to be some vacancy increases. Indianapolis right at 5%. You got some really low delivery markets like LA makes sense. Chicago, that kind of makes sense too. San Diego kind of, makes sense. Again, just not a lot of investment in California and Chicago, and Detroit with really kind of coming down at the bottom, which, I think that there's a lot of tactical opportunities in Detroit. You just have to be really careful getting in the right
there's a lot
submarkets.
of, for sure.